Hi everyone, and welcome to the Simply Wall Street Share Club. So Share Club is just a little thing that we have at the company here where we like to talk about different stocks or talk about investing ideas. And today we've got a little bit of a session that's actually going to be part of a longer series that we're going to do over the next few months to do with pretty much an entire sort of investment journey. And today we're going to start off with one of the first things you probably want to do if you're going to be a new investor or you're just trying to figure out where to get started. So just before we get into it, there's a very important disclaimer on the screen there. We all love disclaimers. Please do take note of this and do read it. I'd like to also draw your attention to the bottom of that, just to say that the presenters, which is myself, Sasha, and Michael, may currently hold or may in the future hold securities in the companies being discussed. I'd just like to highlight that I definitely do hold some of the securities that are being discussed today, so please bear that in mind. I'm just discussing them mainly because I know them quite well and I can use them as examples because of that reason. I'm not making any recommendations, and nothing in here is a recommendation to any of you. Okay, so getting that out of the way, let's just have a quick look at today's agenda. So we're going to start off with a bit of an intro about risk profile and investment goals, which is the topic that we're going to be discussing today. After we introduce that, there'll be a bit of a questionnaire, so I'm going to give you guys probably about 10 minutes to go away and actually do one of these risk profiling questionnaires. And after that, we're going to come back and we're going to see what everyone got and try and have a look at, what we can do with that information. Once you've got your risk profile, how do I use this to actually help myself, build a portfolio or find some investments? So let's actually talk about why you want to have a look at a risk profile. So as Asha's saying there, you've got to check yourself before you wreck yourself. Everyone is different, so there's never any blanket solution when it comes to investing, and you need to have a think about your situation when you actually buy stocks, because they're not all the same. So self-awareness does actually help you to make better decisions that way. So what is a risk profile? Essentially, a risk profile is an evaluation of someone's both willingness and ability to take on investment risk. And most of the time, investment professionals have a look at these primarily, like advisors and financial planners, but it's good for everyone to go through this exercise. And the aim is essentially to just identify, what sort of levels of required return and therefore risk you need to meet your investment objectives, your risk capacity, and also your tolerance for risk. These are related but slightly different ideas. And I just want to say, usually risk profiling is done to determine asset allocations, which is not necessarily what stocks you're going to buy, but how you're going to allocate your investment capital between stocks and other investments, because all of them have different sort of levels of risk and return. But we can still use this sort of concept to also guide ourselves in actually building just a stock portfolio, because it can help. All right, so you might be wondering, what actually influences your risk profile? So I'm going to go through a few high-level ideas and just explain how each of those impact your risk profile, and they generally form the basis of the risk profile. So it can be essentially broken down into a combination of risk capacity and also risk aversion. So the higher your risk capacity and the lower your risk aversion usually equates to someone who has a higher or a more aggressive risk profile. And conversely, if you have a lower risk capacity and higher risk aversion, then you typically have a lower or a more conservative risk profile. Just before I go through some examples, does anyone have any questions either online or in the room up until now?
Maybe on risk capacity, if you can clarify exactly what it means. I think risk aversion is self-explanatory, but what do you mean with risk capacity?
So we're going to go through some examples now, but risk capacity typically is the idea of, what's your kind of financial position right now? Do you have a lot of wealth already? Do you have not much wealth? What's your time horizon? All of things like that actually go into risk capacity. So yeah, actually maybe I probably should have gone through the examples first, but hopefully these will actually help you understand what these all mean and how they feed into a risk profile. So let's start off with some risk capacity ideas. So the first sort of aspect of risk capacity is, what are your investment goals? So, most people have some sort of goal when they invest. Sometimes it's to buy a house, maybe they want to pay for their kids' education, or they just want to retire early, like at the age of 35 or whatever, by, investing all their money in Bitcoin or something like that. So when you think about this factor, typically the more ambitious your goal, the higher your risk capacity is, and the less ambitious your goal is, the lower your risk capacity is, or it actually leads into you having a higher or lower risk capacity, I should clarify. And the reason for that is, when you have a really ambitious goal, typically you need really high returns to meet that goal, which means you have to take on more risk to achieve that, because risk, as Usha said, no risk, no reward. So if you're not taking on risks, then you're probably not going to get the level of reward that you need to achieve your goals. So, if you want a luxury yacht berthed in Monte Carlo, you're probably not going to achieve that goal by going into some really low risk investments. And if your goal is just simply to get your car working like this person here, then you probably don't need some high risk investments to get there.
That guy's going out first.
Yeah.
That was pretty cool, actually.
I'd rather have that.
Okay, so the next one is time horizon, which is, how long do you have until you need to fund a major expense? So this can be either your primary goal or some interim goal along the way. And this will actually determine your time horizon for your investments. Now, I would probably say, when doing risk profiling, this is one of, if not the most important factor in your risk profile. It's not always the case, but it typically is. And the reason why is because the more time you have up your sleeve to achieve the goal, the more time you have to, let's say, recover from, a big loss or something. So if you go into a really risky investment that could either explode or be worth almost nothing, the more time you have, the more time you have to actually recover from any losses, and therefore you can take on more risk. So, in these examples, if you've just had a baby and you want to put them in some private school, well, that's a pretty long time horizon. You've got at least 12 years or something to get the money you need to get them in there. Whereas if your loan shark wants their money back next week, then you can't really take too many risks with your capital. Otherwise, there's a chance you might not have enough to pay them back. Any questions on those two so far? Online at all?
You can see the chat.
I can't, but I can probably see.
I can get the chat, I'll get out.
Yeah. I'll just continue on, and I'll tell you if there's any questions in the chat. So the third factor of your risk profile is your age and life stage. So if you are, for example, entering the workforce, you're probably pretty young, and the younger you are, the more risk you can take on. And that's sort of related to time horizon again. It's also related to the fact that the younger you are, the more sort of earnings capacity you have throughout the rest of your lifetime. If you're about to retire, that means you've probably already been in the workforce, and you're going to retire on whatever investments you've accumulated. but you're not going to have a regular salary income anymore. So that means that's not going to be coming in behind you. Whereas if you're younger, you know, you've got your whole career ahead of you to make a salary, to make investments, etc. So yeah, if you're on TikTok 6 hours a day, you're probably in that high risk capacity group. Whereas if you're like, you know, an older person telling someone to get off their lawn, like Mr. Eastwood, then you might have a lower risk capacity because you're nearer to retirement. Are there any questions at all, Al?
Not yet.
Not yet?
That's
Okay.
why Zoom's not working.
So that could be a good or it could be a bad thing. There's no questions. So moving on, the next factor is capacity for losses. So this is how much can you afford to lose and still be able to meet your investment goals. And typically if you have more capital and wealth behind you, then you can usually take on more risk because you've already got a good base to start with. Whereas if you don't have a lot, then maybe you're in a lower risk category because, you know, if you lose a lot of your investment, then that might be a really high proportion of your overall net wealth. So, you know, if you're like this guy who's worried about the price of fuel for his private jet, you know, you probably have plenty of capital behind you and it's not really going to impact you that much. But if you're finding that you need, you know, 4 or 5 buy now, pay later accounts, maybe you've contacted Wallet Wizard as well, and, you know, you still need some more cash, then maybe you're in a lower risk capacity group. Okay, so those were all risk capacity ideas, and now the next two are to do with risk aversion. So risk aversion, these are more sort of personality traits rather than actual, you know, physical wealth or whatever behind you. So this is more about your state of mind, and this is unique to every person, of course. And it does actually influence your risk profile because it influences how you'll react to certain situations. And you know, most investment professionals and you yourselves, if you're doing this, you want to be comfortable with your investments. There's no point going into some really risky investment, even if you have the capacity, if you're not going to be able to stick through it because, you know, it tanks by like 50% in 1 year, even though it might grow by another 200 in the next couple of years after that. So one of the first ideas is return expectations here. And that's, you know, how much do you expect your investments to return on average each year? So, you know, if you just think all of your stocks are going to the moon, then you probably have a lower risk aversion because you just expect everything that you're going to go in is going to give you really ultra high returns. And on the flip side, if you think, you know, a high interest bank account rate is a really good thing to get excited over, this one's for you, Ansaf, especially for you. After the story he told me about his mate. Yeah, so that means you probably have a high risk aversion because, you know, you're worried about small percentages, you know, between investments that you make, and you probably won't be comfortable going into something that might have a little bit more volatility, for example. And then the next idea is your attitude towards risk. So this is less about expectations, but more about reactions. So how would you react if one or several of your investments fell by a really large amount? So, you know, if you're pretty comfortable and you're just happy to throw more at them, then you probably tend towards a lower risk aversion. But if you get really stressed and, you know, need ways to calm yourself down after a bit of a loss, then that would indicate that you have a higher risk aversion, and you can, you probably have less ability to take on risk because of that. That should be the last one. Are there any questions about all of those? Nope. Okay. All right. So now that we've talked about that, you're probably wondering now, you know, what is your risk profile, or how do you measure it? So one of the ways you can do it is just assessing yourself against these factors and coming up with a judgment on your own. But you know, that might not be a good way because you might be biased, or you might have some preconceived idea in your head about, you know, whether you're able to take on high risk investments or not. So another simple and probably less biased way of doing it is just to fill in a risk profile questionnaire. So these are floating around everywhere. Most financial planners and advisors use them to gauge their clients' willingness and ability to take on risk. The questionnaires usually ask you a set of questions, and they're all to do with, you know, ideas that form around those factors that I talked about. So risk capacity and risk aversion, they just pose the questions in a way that it's a lot easier for you to think about in terms of your own sort of personality and capacity. So the questions usually are then scored and added together, and you'll get a total score at the end of it, and that total score determines your investor risk profile. And then once you've got that risk profile, you can use that not only to decide your optimal asset allocation, but also just make sure that whatever you're doing, you can actually meet your objectives and not exceed your tolerance for risk. So I just wanted to talk about asset allocation very briefly. So just to understand, you know, obviously we're a company that deals in stocks only at the moment. And I just want to get across, whilst we're using these examples and this risk profiling to what we're going to talk later on about what sort of companies might be suitable for each risk profile, I just want everyone to be aware that there's essentially two sorry, let me pose that another way. There's essentially two groups or two buckets of asset classes, and you can align them with like a lower risk and a higher risk bucket. And cash and fixed income are really the only ones that are considered low risk. Everything else, including stocks and also real estate, infrastructure, commodities, and other investments like that, they're all considered high risk asset classes. And shares are, you know, a high risk asset class, and that holds no matter which companies you buy. So that's just something to keep in mind as we go along here. But having said that, you know, not all companies are the same, and it is possible to actually find lower and higher risk companies, and we can select stock investments that we're comfortable with given our own sort of risk profile. Okay, so now that we've done that, if there's no questions at the moment, we're going to take about a 10-minute break now. If you don't have it already, I think Mike or Ema is going to send you a questionnaire around to do yourselves. It shouldn't take you too long. I don't think it will take 10 minutes, but you know, you can feel free to go and grab a cup of tea or something. You know, let your brain reset from all that boring chat, or just you know, have a think about what's in the questionnaire. So when you're doing the questionnaire, just kind of keep track of your score as you go. There'll be a number next to each answer within each question, and once you've got that tally up, just kind of add up your score and keep that for when we come back in 10 minutes. And if you've got any questions in the meantime, just Slack myself or Michael, and we'll try and help you out. Okay, everyone. So that's been about 10 minutes. Hopefully everyone's done and they've taken note of their score. You don't have to share it with anyone if you're not comfortable. We're not going to ask you for that, but we're just going to go through every investor profile, and you can pick out, you know, where you sit based on your score. So for this next part, Michael's going to be presenting the next little portion. So it's over to you, Mike.
Thanks, Sash. Alrighty, can you chuck that onto the next slide, please? Thank you. Alrighty, so hopefully everyone should have their scores by now. And if you've got the number in front of you, you can check here against what type of risk profile you match up with. So as you can see there, if you answered questions that were typically lower in the points that they were allocated, you'd be closer to the defensive side. And if your answers typically were higher, around the 50 or 40 mark on average on total, you'd get down to the high growth section. So in this next bit, we're just going to go through each profile individually just to give everyone an idea of which one they landed on and what that typically represents in terms of what type of investing style you would do for yourself personally. So Sash, could you click the next slide, please? So first up, if you're a defensive investor, on the questionnaire you just did, you would have scored got a score between 0 and 120. So if you were in this category, basically you're very risk averse. You don't want to take on much risk. You actually don't mind getting lower returns at the purely for the primary goal of preserving your capital or preserving the wealth that you do have. You're not out there trying to chase ridiculously high returns. You just want to protect the money that you do have. With that being the case, it actually means that you're not too concerned about the negative effects of tax and inflation, just as long as your money is safe. You don't want to take on risky investments. You just want to protect what you do have. So if you got 0 to 120, this is what a defensive investor is like. Sash, next slide, please. If you got moderate, it says you're a moderate investor. It isn't referring to your skill, it's referring to your risk tolerance or risk profile. So you're basically just one level up from the defensive, seeking better than basic returns, but you're still pretty risk averse. You still don't want to take on too much risk either. You're typically a bit older, and just like the defensive investor, you're seeking to protect your wealth that you have got. And yeah, you're not just generally chasing very aggressive growth. You're more concerned about preservation rather than accumulation. Next slide, please, Sash. So this is for the balanced investor. If you scored between 231 and 340, that's where you sit. Basically, you want a balanced portfolio that works towards your medium to long-term goals. So you want an investment strategy that does handle tax and inflation. So meaning basically you're seeking better than average returns. You want to take calculated risk, but you want to get returns that can handle the effects of inflation and tax, and you're willing to take some risks. Next slide, please, Sash. Next one up is growth. So that's if you score between 341 and 460. So you're a growth investor. Basically, you're earning sufficient income in your primary occupation that basically any funds you're investing are for capital growth purely. You're prepared to accept higher volatility and risks because basically your primary goal is that you want to accumulate a lot of assets over the medium to long term. So all the money that you are investing, you pretty much don't need it straight away. You're not looking to live off it right now. You're looking to accumulate over the long term. So while you'll have a balanced portfolio in the sense that there's some aggressive investments and some defensive investments, generally you'll have aggressive investments that make up a higher proportion of your total portfolio. Next slide, please, Sash. And this is the very top, the high growth investor. So if you scored between 461 and 500, you're a high growth investor. Basically, your entire most of your portfolio is basically purely focused on long-term capital accumulation and long-term returns. Big returns over the long term. While the investments that you do pick are diverse, a lot of them will typically come with a lot of risk. So it's referring back to the thing Asha said at the start, no risk, no reward. You're chasing high gains, but then at the same time, you're able to handle any sort of capital loss that can come with that. So preserving your capital is not as important to you as basically the potential for wealth accumulation. So you're willing to take those risks and you're looking for much larger returns than a more conservative investor. Next slide, please, Sash. Sweet. So Sash will do this next slide, but this here is just, we want to do an exercise. So as Sash mentioned at the start, shares as an asset class are typically considered higher risk if you compare them in those two buckets. So we're just going to go through a set of companies here. We just wanted to help a bit where while shares are considered higher risk, there's companies within the share market, some can be considered higher risk and some can be considered more conservative, depending on the nature of those companies. And given our business focuses on purely stocks at the moment, we figured it would be a good exercise to go through and try and help identify what companies might suit different profiles. Now, again, these aren't recommendations. These are just purely for illustration purposes of what might be appropriate, and just to give you some ideas and context around what you might want to, what might suit a particular profile. Yeah, so these are high level. We haven't looked into these companies fully. We just wanted to put them up here to help us get some context. So with that being said, Sash, I'll pass back to you for these first couple of companies. Oh, and one thing I should mention, sorry, is we're presenting 2 companies per risk profile, but only one of them is appropriate. And the idea is we want you to be able to decide, don't have to submit your answers, but we want you to be able to determine which one would be more appropriate out of the 2 for that particular risk profile. So I'll pass it back to you, Sash.
Yeah, thanks, Mike. Yeah, so as Mike said, we're just going to go through a bit of an exercise now. It's just a little bit of fun, you know, none of these are recommendations. And just bear in mind, like, keep in your mind, like, which risk profile you are. I'm happy to tell you guys I came up as a growth. That didn't surprise me. That's what I would have picked out. As I said, you know, most risk profiling depends mainly on your risk aversion and your time horizon / age. So I would be probably surprised if anyone's less than a moderate here. Maybe there are, but I'm going to guess most of you are probably in the growth, maybe some in high growth, maybe some in moderate. Sorry, not moderate, balanced. So some in balance, some in growth, some in high growth, but regardless of that, we're going to go through every risk profile and just give you guys some idea of what kinds of companies suit that particular risk profile and what should I be looking for. So just bear with us a little bit. We're going to be using the Simply Wall Street platform for this, for some of these checks. So let's go into it. So the first risk profile we had was defensive. So as Mike said, you know, defensive investors, they're right at the bottom of the risk profiling list. They're the most conservative. So have a think about like what types of stocks might be suitable for that type of investor. And you know, here's a couple of examples. Yeah, I'm still on this one for now. Oh, you mean the slides?
We gotta change tabs.
Yeah, we're going to change tabs, so I just have to stay out of it, unfortunately. Yeah. Is it a bit too small?
No, it's good.
Okay. Yeah, so the first one we've got here is Voyager Therapeutics. So Voyager is a pre-revenue clinical stage gene therapy company that focuses on development of treatments for patients suffering neurological diseases. The company's lead clinical candidate is some coded pharmaceutical product, which is in phase 1 clinical trials at the moment. So, you know, we probably don't even need to look at Simply Wall Street for this, but have a think about, like, does that sound like an investment that would be suitable for someone with a defensive profile? It's essentially the company that has no revenues at the moment. The only revenue that it's received is from grants and investments from third parties, and you know, its top clinical candidate is still in the first phase of trials. And for those who aren't familiar with trials, you know, from phase 1 to, you know, selling a product is probably like, you know, 3 to 5 years, if not more. And you know, just to kind of back that up, we can always have a look at Simply Wall Street and have a look at this company, and you know, here's sort of earnings and revenue, a bit of history and the forecast for them. And you can see that they made a profit for 1 year, but that was, you know, because they're getting grants and investments from other companies. They're not actually selling anything, and they're not predicted to make a profit until, you know, sometime after 2025. So open question, you know, is that potentially a suitable company for a defensive investor?
Can I ask a question? Like, if you're just getting grants from other companies, should that be recorded as revenue if they're not actually generating anything themselves?
It depends on what it is. The grants are probably from the government or some, government authority or some organisation. The investments would probably be coming from other companies. Whether it's booked as revenue or not depends on the situation. If it is booked as revenue, it's not operating revenue, it's like other revenue. So you can actually look that up as well when you have a look at the company's financials. But essentially, yeah, they'll tell you in their annual reports or any other quarterlies whether the revenue is from operations or not. And when you look this company up, you'll find that it's not coming from any sales. So that's how you would know. But yeah, to answer that question from before, this is probably not a suitable company for a defensive investor who's looking for something conservative, because companies like these, they're very high risk, they're not making a profit, and the potential for profit is most likely a binary outcome where they'll either explode or they might, just become worthless. So I'm going to say that's not a suitable investment. However, here's option number 2, Duke Energy, which operates as an energy company in the United States. It operates through 3 segments, which is utilities, electric utilities, infrastructure, gas utilities, and other commercial renewables. The company pays a high and growing dividend, so we can check that out. So if we go down to the dividend section, this is a nice little chart there. It shows you how over a pretty long period of time, earnings has been, dividend's been growing pretty much almost yearly, and the dividend yield's been relatively stable. It had a little bit of a dip, but it's thereabouts at a similar level. And on top of that, if you look at their past performance and actually now let's have a look at future performance, you can see that revenues are growing but slowly, and same with earnings over time. They're expected to grow but fairly slowly, and overall you'd say that looks pretty stable in terms of future growth. So I think that type of company is probably a lot more suitable for a defensive investor, because they're not only getting a stable company with fairly predictable revenues and earnings, that's because this probably has a lot of revenues that are regulated by the government. So you'll find that most utility companies can forecast not only their earnings but also their dividends many years out into the future with high reliability. So I would say that's probably a much more suitable company for a defensive investor. Anyone got any questions about that? Does anyone like any of those companies? Or yeah. Okay, let's move on. All right, so the next risk profile up is the moderate investor. So moderate is sort of similar to a defensive, but they might be able to accept a little bit more risk and search for slightly more growth than just a purely defensive investor that's mainly looking for income and capital preservation. So we've got another 2 example companies here. The first one is Aflac, which is an insurer, and Aflac essentially provides supplemental health and life insurance products. Now this company has pretty low earnings volatility, it's got a modest balance sheet, and it pays a pretty good dividend, I think. So let's have a look at that. So if we have a look at their past performance, that looks relatively stable. Revenues and earnings have pretty much stayed on track for most of this period here. If we have a look at their financial health, we can see they've got a pretty low debt to equity there, and they're passing a lot of their health checks on the Simply Wall Street website. So that looks pretty good overall. And one other thing we like to look for moderate and defensive investors is what's their dividend like, because income's typically pretty important. And, you know, it looks very similar to Duke Energy that we just looked at. Pretty stable and growing dividend, seems to increase almost yearly. And the dividend yield, you know, this one's a little bit more volatile, but, you know, it's still pretty solid overall, meaning it's likely the share price isn't too volatile. So that particular stock, I would say, you know, looks pretty suitable for a moderate investor. On the other hand, we've got another example underneath that, which is Afterpay. Probably most of you know about Afterpay. It's a buy now, pay later style payment solution provider. Operates in Australia, New Zealand, the States, Canada, and the UK, but it's still expanding. It's got, sorry, that should say very high revenue growth, not earnings growth. So it's got very high revenue growth, but it's yet to break even, and its earnings have actually been decreasing over the last couple of years. So we can check that as well on Simply Wall Street. So if we have a look at these growth forecasts for the company, we can see that, you know, it's expected to grow its earnings pretty rapidly, like 63%, and also revenue growth is also in almost the mid-30s. That's very high. And if we have a look at just some longer-term expectations there, as you can see, you know, it is predicted to grow very quickly with revenues shooting right up there through 2025. But as I said, if we look at their past performance, these guys have never been profitable, and, you know, even in the last sort of year or two, their earnings have been reducing, or sorry, the losses have been increasing rather, probably because they're reinvesting a lot more back into revenue growth. So having a look at that and comparing it to Aflac, you know, we'd probably say that this company isn't suitable for a moderate investor, just because, you know, it's got not only you know, those sorts of financials, but it's a very volatile stock. You know, it's sometimes up or down $10 in a single day, which doesn't really suit a moderate investor. Okay, any questions about those two? Let's get the next one. Okay, so now we're up to balanced. So with the balanced, it's you know, probably somewhere in between the high growth and you know, what we've been looking at now. You know, balanced investors are willing to take a little bit more risk, but, you know, they're still looking for something that's going to be relatively stable over the long term. I'm guessing there's possibly some people in this risk profile. So here's a couple of example companies for you to think about. Wesfarmers is the first example. So Wesfarmers, some of you may not know the company necessarily, but you probably know the businesses. They're an investment conglomerate, which means, you know, they typically buy some business and try and build it up or grow it, whether it was in distress or not before that, and then sell it off for a profit. They mainly own retail businesses at the moment, and some of those include Bunnings and Officeworks, which I'm sure you're all aware of. Others are also Kmart and Target. They also own them too. And aside from that, they also have some other smaller stakes in some coal mining, chemicals, fertilizers, and some industrial stuff and safety product businesses. One of the aspects of the company is that it's shown pretty consistently high and stable revenue growth for many years. It's got a good balance sheet, and once again, it pays pretty solid dividend. So the way, you know, I determined that was, you know, if you go to the Simply Wall Street site, you know, let's have a look at, for example, their earnings and revenue growth forecasts here. So you can see, you know, it's growing pretty steadily over time. There was a big dip here this wasn't actually bad performance. This is because they also used to own Coles, the really big supermarket in Australia, and they sold that off around that time. So their revenues dropped just because they sold that business, but shareholders actually did really well out of that because they sold it at a pretty good premium. So that looks pretty good. Additionally, we said their financial health was decent. You see it passes a lot of our checks, and also it's got quite a conservative debt to equity ratio, which is nice to see. And finally, dividend. It's not at the top for the Australian market, but it's still pretty decent. That's not a bad dividend for people looking for a bit of income, and their dividend's been pretty good over the last 10 years or so. It's a little bit more volatile than some other companies we've looked at, but the yields are still good. So that looks all right. How about Gamestop? Now, yeah, you probably all heard of Gamestop. Maybe some of you own it. Maybe some of you are short it. I'm not sure about that. But if you haven't heard about it, it's multi-channel video game, consumer electronics, accessories and collectibles retailer, and the company pretty much sells new and pre-owned video game platforms and video game software. One of the things about GameStop is that its business is in structural decline. Most people aren't really going to buy their video game products in stores anymore. They can just access that online through Steam or through other platforms. And recently, it's been a really highly volatile stock that's been popular with short-term traders and shorters. So if we have a look at this thing, let's look at the share price. This is the really nice one. Yes, that is minimum $13 in the last 3 months, whereas it's gone up to a max of $347, and then come back down again to 51. 44. Yeah, it is. Well, yeah, it's now up here again. So, yeah, that's pretty volatile. And just to confirm also their past performance, I mean, yeah, that doesn't look too great, does it? It was making a profit for a long time, and its revenues are just tailing off, and earnings are pretty much going along with it. So, for a balanced investor, comparing that to Wesfarmers, I'd probably say you don't want that sort of volatility in your portfolio if you were just a balanced investor. Okay. So yeah, if no one's got any questions, I'm actually going to throw it to Mike for the next bit. Do you want to present your screen, Mike, or?
Yep, I'll share my screen.
I think you'll have to actually. You've got the stocks
Yeah.
open there, haven't you?
Yeah, same tabs.
On my computer. I don't know, sorry, that's fine. Yeah, that's right. That's okay.
Alrighty, you guys can see that? Yep. Whole bunch of waving. Yep, cool.
Yep.
So as Sash has gone through the last couple, this is now the company's example with the growth ideas, or one that's appropriate and one that isn't. We want to compare Xero and Xerox. Now, very similar names, but not to be confused. Just like that story where people were buying GME resources because GME stock was going up, but GME was referring to GameStop. So don't make that confusion with these stocks. So first one is listed in Australia. It's Xero. It's the software as a service accounting software that has some complementary services as well. It's considered a growth company mainly because it's got very high predicted future earnings growth and pretty solid revenue growth as well for the next 5 years. Mainly because it's also got a very large total addressable market. So at the moment, it's probably about $14 billion. Or I think last year or so, Goldman Sachs predicted to be about $14 billion, and they're only about 5% penetrated into that market. And if they get some complementary services as well into their ecosystem, their total addressable market then goes up to 62 billion if things go to plan. So there's a lot of runway for growth there. And so far the company's been performing well. Just looking at the Simply Wall Street site, we can see here that's evidence in the future performance. So it's currently last reported September 30 last year, and it's kind of hard to see because of the screen, but you can see that the revenue and earnings are both up and to the right, which is very appealing to a growth investor. So that's what you'd be looking for. They've done well in the past as well. You can see their earnings growth. They've been doing really well to grow the top line. Earnings, not so much, but that's just because, similar to some examples Sash gave, they've been reinvesting in the business and haven't been focusing on profits now. They've been focusing on grabbing that market share, getting those users and having that sort of recurring revenue from them once they're embedded into their own business. From a financial health point of view, it's got a pretty good balance sheet. So just in terms of downside protection for a growth investor, like you look at its future and you see that it has a lot of upside potential with that. And then when you're looking at the actual balance sheet, you see that it's pretty solid. Yes, it does have a fair bit of debt recently, but it's because of a few different initiatives they've been running and acquisitions and stuff. So that looks pretty okay there. The debt looks manageable in this sense. And yeah, so from a growth point of view, that company seems pretty appealing. Then if you compare that with Xerox, very similar name, very different business. So some of you may already know Xerox, but the gist of it is that they specialize in printers and copiers. Now, while that's been a very big market for them in the past, their business has been in the sort of structural decline in the last couple of years, as a lot more digitization has been happening, and people have been going more along the path of just software rather than physical paper and such. So earnings have dropped 82% since 2014, which is quite a shock, and revenues dropped 64% since then. So if we look out over the future, they've got flat revenue and earnings growth over the next few years as well, and they've got an okay balance sheet. So I'll just look at that here on the platform as well. Future growth, as you can see, for both earnings and revenue are both very flat. Past performance is down here, and it's been quite an ugly shrinkage for those 6 years. And the financial health is okay, but in terms of being applicable to a growth investor, it's given its forecast for the future, they're probably not that applicable. One thing that, just even though it was a high level review, one thing that we found was they actually own the Palo Alto Research Center, and just a little bit of digging from what my understanding is that a research center invented some very lucrative sort of inventions, such as like the mouse and some personal computer stuff, and they sold a whole bunch of those rights to other people. And if they had kept those licenses themselves, they could have done very, very well, but they didn't actually see the commercial value in it, so they sold it. So one little side note that I'd mention is they still have that Palo Alto Research Center. So if they were to create anything, it could, throw a little kick into their revenue and earnings if they were to somehow invent something and make it commercial. But that's a Hail Mary. Like you're betting on a very low probability event there. And while it may have high payoff, it's, just something to keep in mind that its likelihood may not be that high. So for a growth investor, these two applicable would probably more so be Xero, just because of the reasons mentioned above. Next one is high growth, as mentioned before. So we've got two companies here.
Mike, we've just got a question here.
Sorry, yep.
Sorry.
Yeah, sorry, mate. I was just curious to know, even though Xerox isn't considered good for a growth investor, would you consider that it would be a good investment for any of the other more conservative categories?
Yeah, it's a good question. I suppose given its future prospects look flat in terms of revenue and earnings growth, that might be applicable. So they're paying a dividend from what I remember, and they don't seem to have any pressing issues with their leverage. So it could be more appropriate for like a small allocation if you're looking for a dividend. Actually, let's have a look. Sorry, let me move this. Yeah, so they're paying a moderate dividend, and yeah, that could be more appropriate for a more conservative type investor if you were looking for, you know, just steady sort of low yield income. Yeah, Sash, do you have any comment?
Yeah, so as it stands right now, it might be suitable, but you know, the question around Xerox is probably outside of the risk profile sort of arena and more around, is it an actual good company? And you know, it might fail on those fronts because, you know, at the end of the day, if their earnings are dropping and their revenues, then, you know, that dividend might not be sustainable. And if that drops off, then it's no longer considered good for a defensive or a moderate investor because A, you're not getting income, and B, you know, you're probably not preserving your capital because it's likely that share price is going to keep declining. Does that sound about right, Mike?
Totally, yeah.
It's probably a turnaround stock.
Yeah, that research and
It's probably high risk.
You're going to convert all those printers into.
Yeah.
It is one thing we considered. Yeah, quite a Hail Mary though, but worth keeping in mind. Yeah, so the next category is high growth. Two options we have here is, first one is Marathon Digital Holdings. Basically, they're a cryptography miner. So they are very early stage. They have only 1.9 million in revenue. They made a loss of 6.4 million for the year to September last year. And they, however, for the future, they've got very, very high expected revenue and earnings growth. The risk being, though, that they have less than 1 year of cash runway. So we'll have a look at their future forecast here. You can see here they're just a huge uptick. I think some people call that a hockey stick, but huge uptick in earnings and revenue. So that's what would be applicable to like a high growth investor. You're looking for that sort of huge growth. They haven't really had much of that in the past. They've been quite, as you can see here in the graph, quite flat line in terms of revenue. I didn't look into it, but I'm not sure what happens back here. And in terms of financial health, while they do have much more assets than liabilities, they are quite short on cash. So that's just something to keep in mind, that they'll probably need to go and either fund externally through a capital raising via equity or debt. So if you're a growth investor and you are looking at it that way, you might just keep that in mind. And the risks associated with each of those, either more leverage, which means solvency risk, or more, if they issue more equity, you might be diluted. So this is an example of a high growth stock. The next one is Origin Energy. So they're in Australia. Basically, they provide natural gas, or they explore and produce natural gas. They generate electricity, and they sell in the wholesale and retail markets in Australia. Now, it has very flat expectations for revenue growth, and although earnings growth is expected to be 58% for the next year, it's not going to stay like that forever. That's just because they had a pretty poor year over the last 12 months, and it's expected to revert back to more of a normal trajectory. And so for a high growth investor, Origin Energy isn't really operating in a high growth industry. So it might not be too appropriate if you're looking to make 10 baggers rather than maintain your wealth. So you can see here the future earnings and revenue are pretty flat line from here on out for the next 5 years. At least that's the expectations from the analyst who covers it. And then the past performance, while it's been okay, it's not nothing standout and nothing revolutionary. And in terms of their financial health, while they have got a lot of long-term assets, they're doing pretty well on the balance sheet side there too. So yeah, just between those two, if you were a high growth investor and you're looking between both of them, not saying you would pick Marathon, but it might be more appropriate if you're looking for a multi-bagger rather than just to maintain your wealth. Any questions with those two? I didn't ask on the last one either. All good. Sweet. Okay. So yeah, just to wrap that up, the next process, which we're not doing today, but just something to keep in mind, is portfolio allocation. So while you've probably identified, or you hopefully have today after doing the questionnaire, you've identified which risk profile you are. Just something to keep in mind is that although these companies we would argue that they could be suitable for those risk profiles, it doesn't mean that you should only hold those type of companies. Risk profiles is very more leaning towards portfolio allocation, like how much of a risky asset you would want to take on and how much of a lower risk asset you would want to hold. So while these companies and companies of those sort of nature would form the bulk of your portfolio, depending on your risk profile, it doesn't mean it should be all of it. So you should basically just tilt your portfolio towards these type of companies instead of going all in on the one. But portfolio allocation is a huge topic unto itself, so we can talk about that another time. But yeah, from Stash and I, that's pretty much the total risk profile, Frezzo. So does anyone have any questions there?
Yeah, that was really good, guys.
That was awesome.
Probably one area that we didn't touch on is like the riskier option is also like a chance of it not succeeding. So it's kind of like that kind of like, it looks like, oh yeah, why would you not go for more risk, more return? But it's, yeah, this is that kind of chance of success is an interesting one to think about as well. Like it kind of, it's hard to get your head around for a lot of people, you know?
Yeah, so we're definitely going to cover more of the like company level stuff in a couple of the sessions later on. But yeah, that's exactly right. You know, like Marathon, for example, the reason why it's suitable for a high growth investor is because it might not do anything. It might completely tank, but that investor should be able to take on that kind of risk and recover from it if that does happen. Whereas, you know, lower risk profile investors might not be able to take that sort of loss, or, you know, their time horizon's too short, they can't afford that in a short time frame, and they don't have time to wait for a recovery or to put their money in something that does better. But yeah, that's a very good point, and that's exactly why we wanted to say at the start, you know, those are definitely not recommendations. We're not saying invest in the ones we said were suitable or don't invest in the ones that are not. At the end of the day, you still need to pick quality companies, and you also need to have a think about, you know, how your portfolio looks as a whole. Like, you don't want to just own companies like that. You might want to have a mix of something a little bit more defensive, but still have more of a growth tilt. And then that way, you know, if your high growth companies don't do that well, at least you've preserved some of your capital with your other investments, and vice versa.
How much would you consider when even looking at the high growth companies, for example, how much of that expectation is already reflected in the actual price? So for example, you might look at Marathon, but the market is actually already pricing in the fact that it's going to succeed, and therefore it becomes like the reward isn't there. That's what the market's already doing. Probably say the same about Tesla.
Yeah, so at least in theory, like the risk of that company should be baked into the share price as well. So as their revenues and their earnings de-risk because they start achieving interim goals or whatever it is, you know, if they've got some product that's about to come out and there's high expectations around it and it does really well, then that should see the company re-rate, you know, because a lot of the risk is then taken out of it. So although they might be trading at really high levels, you know, at least in theory, there should be some risk premium attached to it, which is, you know, extra return that you can get by them actually achieving what they've promised that they'll achieve. But yeah, as you know, in practice, that's probably not always the case, and especially now, there's a lot of companies out there that are just trading at levels that don't really seem to make sense for most people. Maybe for some, but I'm probably not one of them. Cool. Any other questions on the chat?
Yeah, Xerox like had the opportunity to be Apple and Microsoft. It's quite funny another story. Jason was mentioning it, but yeah, it's quite well known that they Activision like invented a ton of stuff and they just had no idea how to commercialize it.
Yeah.
Yeah, it's really fun.
it up there, everyone. Thanks for joining, and hopefully that was really informative, and you all got something out of that. You know, at least now you should know your risk profiles, and that should help you with you know, your investments and just thinking about what type of things you might want to look at investing in, which we'll probably discuss in later sessions in more detail. Okay, thanks guys.
Thanks, mate.
Thanks, guys.
Yeah.
Thanks, guys.
Thanks, guys.
Thanks, guys.
That's great. Thank you.